Today, we'll consider two perspectives, one from an active asset manager and one from a full-service index provider, and delve deeper into the strategy that informs each one. So let's start with some definitions and context around sustainable investing today, which notably is focused on the energy transition for a majority of investors, but also incorporates a wider range of factors. And Rob, Stewart takes a broad view of sustainability and includes elements of stewardship and human development. Tell us about your approach.
Thank you, Howard. In very simple terms, sustainable investment for us means investing exclusively in high-quality companies that are positioned to contribute to and benefit from sustainable development. And we invest this way because we think sustainable development is a driver of investment performance, and also because we care about trying to make the world a better place for future generations. Now, I mentioned sustainable development. The simplest definition of sustainable development is economic and human development that meets present and future needs, but without depleting the planet's environmental resources. And the chart on this slide here, produced by the Global Footprint Network, I think captures the idea and the challenge very well. On the vertical axis, you can see ecological footprint per person, and on the horizontal axis, the Human Development Index, which is really a combination of measures of education, income, and health or life expectancy. And it tells a story about how countries have developed, which is that as populations and societies have grown richer, their populations have become wealthier, better educated, and up to a point, happier. But we're also using up more and more resources at an exponentially faster rate. And we're now using up resources 70% faster than nature can regenerate. So we have to find a better way of doing things, and sustainable investment can be part of the change. Now, we invest in companies that are helping economies move towards the bottom right green area of the chart, which is high human development and low ecological footprint. And to help us judge whether and how well companies achieve this, we use two main frameworks, which we'll touch on again in a moment. But just to introduce them very briefly, if we could go to the next slide. The first is a human development framework, which we've developed ourselves, drawing on the work of the Nobel Prize-winning economist Amartya Sen, who put forward the idea of development as freedom. Map all our portfolio holdings across all our strategies to 10 human development pillars, which we've defined. And the second framework is one developed by a non-profit called Project Drawdown, which has identified over 90 technologies and practices that can help us to a 1.5 degree warming target and do that quickly, safely, and equitably. So we're looking for companies that lead either to the human development pillars or to the Project Drawdown climate solutions or to both. And all our holdings contribute to one or more human development pillars, and about 2/3 contribute to one or more Project Drawdown climate solutions. The last thing to say on this is that, and this is very important, although we're looking for great sustainability companies, we're also looking for very high quality companies. They aren't always the most popular sustainability names. But if we can find these great quality, great sustainability companies, we find that we're investing in some of the most imaginative and forward-looking and ambitious and long-term focused and well-run companies which are led by some of the responsible stewards who care about all stakeholders and not just shareholders. And because of all of these things, in our experience, they're some of the best performing and least risky companies to invest in.
Thank you, Rob. Good overview of the factors that you look for in sustainability. Thomas, I beg your pardon. How do you distinguish ESG from sustainable investing? And how do you approach the spectrum of solutions for a passive approach?
Mm-hmm. Thanks for the question, Howard. So at Morningstar Indexes, as an index provider, we're scorekeepers, facilitators, and storytellers, right? The scorekeeping part of it, of course, is the benchmarks we create measure risk and return, but they also enable us to measure the sustainability characteristics of investments. As facilitators, we're in a position to help asset managers create funds, passive funds that investors of all kinds, whether they're retail, wealth management, or institutional, can invest in. And as storytellers, indexes really help develop a narrative around how markets are operating and performing and their outcomes. At Morningstar Indexes, you can see on the left-hand side of this slide, we define sustainable investing as sort of the overarching category, and within that, there are three types of sustainable investment strategies representing different approaches, and those are ESG, climate, and impact. And we can talk about some of these more as we go through the conversation today, but I want to focus in particular on climate strategies and their roles in a portfolio. Because within climate, we distinguish what we call low carbon, which are basically attempts to reduce portfolio carbon intensity, climate transition, which are more aimed at sort of understanding net zero pathways and focusing on real economy decarbonization, and then climate solutions, which involve various aspects of climate change mitigation, the development of enabling technologies for the transition, and also transition finance in the form of things like green bonds. But what's also important to see in this framework is where they fit in, where these different approaches fit into asset allocation. You can see that the low carbon and climate transition activities are really tend to be more broad market and can serve as core holdings within a portfolio, whereas climate solutions are often where investors hunt for alpha and maybe satellite holdings in a portfolio. And so this sort of presents a way of thinking through the different kinds of investments that we're seeing these days.
Thank you, Thomas. And when considering sustainable investments, asset owners now expect to see both robust returns and superior risk mitigation on ESG dimensions. Let's look at some ways that they're pursuing these dual goals. And Thomas, staying with you, what are some findings from Morningstar Index's recent asset owner survey?
Sure. For the past 3 years, Morningstar has conducted a survey we call the Voice of the Asset Owner Survey. It's an annual survey of 500 global asset owners. This is the 3rd year we're doing it, and we just launched the results yesterday, so I'm happy that we're in a position to talk about them today. We do the survey in conjunction with Opinium, which is a market research and survey firm, and we work with them each year on the development of the questionnaire through a series of in-depth conversations with asset owners to sort of inform how we're going to modify the questionnaire we send out to the broader audience. And this year, we surveyed, as I said, 500 global asset owners, 100 in North America, and 200 each in APAC and Europe, representing $18 trillion in assets. So fairly sizable institutional investors. And one of the things I want to focus on here is the fact that for the last 3 years, the results on a question we ask about materiality of ESG factors has been pretty consistent. And what it shows is that 2/3 of asset owners believe that ESG is either much more or more material, has become either much more or more material in the past 5 years. In other words, we're trying to take a sort of a longer term perspective on how they see the materiality of ESG. And the relevance of this is that from a fiduciary perspective, it provides the rationale basically for asset owners and asset managers to take account of ESG factors in their investment policies and their investment practices. And this has been really sort of an important element in the mainstreaming of ESG and sustainable investing over the past couple of decades, as it's become more embedded in mainstream finance as a result of the fact that it's consistent with fiduciary duty. So if we go to the next slide, we can drill down a little bit more into this materiality question, looking specifically at each of the 3 pillars and asking the question of whether or not environmental, social, and governance factors have become more or less material in the past year. And what we see is that with environmental factors being, I would say, the most material within the past year, roughly 4 times as many people say it is more material or much more material than say it's much less material or less material. And when we see similar numbers, not quite as high for social factors and governance factors as well. But what's really striking in this year's survey is the extent to which these numbers went up from last year's survey. This is sort of in the 3rd year of this survey. It's given us the opportunity to really see how trends are developing, or in some cases not developing, with some of the questions we've been asking. And in the case of environmental factors, they were up about 12 percentage points. In the case of governance factors, also 12 percentage points. But in the case of social factors, they were up 20 percentage points, which is really a rather striking move. The fact that all 3 of them are up significantly, and the fact that social factors are up by as much as they are. So again, this just reinforces the notion that these issues broadly and more specifically are becoming increasingly material from the perspective of asset owners. And of course, the relevance of focusing on the interests of asset owners is that they really drive the investment value chain. The decisions that they make based on their investment policies, working with investment consultants and developing their asset allocation models, really drive a lot of the activities on the part of asset managers. And so we really wanted to drill down into the details of what it is that makes asset owners tick. Going to the next slide. This is one I thought was worth sharing because it bears on regulation, which is an increasingly important issue in impacting the activities of investors who are taking into account ESG considerations and other sustainable investment factors. Because in essence, regulation represents the fact that the field has reached a level of maturity where it needs more definition and more clarity about standards. And regulators are essentially stepping into or have been stepping into a set of investment practices that have developed rather organically over the past several decades. And in particular, what we've been focused on is two things. One is better disclosure by companies in order to ensure that investors have information they need about issues that are material at these companies, bearing on environmental, social, and governance issues and factors. But also, they're looking at protecting the interests of investors, and that's where a lot of the fund naming and anti-greenwashing regulations are coming online in some jurisdictions. And what this shows basically is that, again, looking at the results for this year, we've got it for all 3 years in the graphic, but just looking at the results for this year is that there's basically a 2-to-1 ratio in which asset owners are saying that regulation has been a major help or a slight help as compared to a major hindrance or slight hindrance when it comes to the implementation of ESG strategies. And I think that's pretty telling because by and large, regulation is not always welcome, but it does, I think, represent an important stage in how this field is shaping up as it becomes increasingly influential and more assets are invested in ESG strategies.
Thanks, Thomas. That's great data and interesting insights there. Rob, turning to you, what do your investors share about their sustainable investing goals today?
Our client base is quite diversified, and it's broader than only the asset owners who might be tuning into this webcast. So we come across quite a range of different goals and motives. Where there isn't a whole lot of variation is on performance. All our investors want to achieve better than market average returns with below market average risk, which is what most of our strategies have managed to do over 10 years and longer. Otherwise, I think most investors like the idea of their capital going into companies that are helping make the world a better place, but their ambitions in relation to this differ quite a lot. Some just want to avoid controversial industries and remain true to exclusion policies that they might have. Some are a bit more positive about their sustainability goals, and some are particularly interested in specific sustainability issues and themes and contributions that companies might be making to sustainable development. I'd say another goal that's widespread and also widely shared and becoming increasingly important to more and more investors is the one that Thomas touched on, which is more investors want to have clarity and transparency about the companies that we invest in on their behalf. And this makes complete sense to us. And it's why we've opted for a policy of radical transparency. So we disclose all the companies we invest in across all our client portfolios, and we've built an online tool which is accessible through our website called Portfolio Explorer, which is featured on this slide. And in the Portfolio Explorer, we showcase and tell the story of every company that we hold on behalf of our clients. You can click on the map, the location of the company to access the information. And we share our reasons for holding that company and why we like it, the risks to the company as we see them, the areas in which we think the company could improve, and the contributions that the company is making to human development, to Project Drawdown Climate Solutions, and also to the Sustainable Development Goals, which are quite liked and are relevant for quite a number of clients. And our aim really with all of this is to share our thinking about the quality and the sustainability positioning of every company we invest in, to render our thinking, to show our working, if you like, and then to invite discussion and debate and challenge with and from our clients about the companies that we hold for them.
Thank you, Rob, for your insights there. And then turning to data, the uneven development of data and data quality, along with a lack of commonly agreed standards, have been challenges in ESG and sustainable investing. And now we have AI and machine learning that's faced even more data sources. So what to do? Rob, staying with you, with so much data available, where do you focus? What sources yield the best information for identifying opportunities, measuring risk and return, and meeting sustainability standards?
Yeah, I think we try and focus on the data and information that is relevant and meaningful for us and for our way of investing. And that means being quite discerning and willing to cast aside or pay no attention to the vast oceans of data that just keep growing. So we're bottom-up investors, and that means we try and understand the world and investment opportunities through the prism of companies rather than through top-down or macro lenses. And this is because, well, we're investing in companies first and foremost. We're not investing in countries or sectors or indices or any other category of thing. But there are roughly 50,000 listed companies out there, depending on your source. And all except a small number, perhaps only 500 or so in our view, are really worth analyzing and following closely. And the rest aren't worth looking at because we think they'll make poor investments. They may have poor leaders and suboptimal cultures, or corporate governance weaknesses, or poor pricing power, or weak balance sheets. And they may be facing sustainability headwinds rather than being well positioned for sustainability tailwinds. So, we just want to focus on the companies, as I said earlier, that are high quality, great sustainability companies. And because our portfolios are relatively concentrated, we don't need to find a huge number of ideas. We just need to find excellent ideas. But the next challenge is that good ideas aren't evenly distributed. So this is where we think it's best to try and think independently and to ignore benchmark indices. And also, we're very wary of the iconic sustainability names. There are plenty of companies with wonderful sustainability stories to tell that make poor quality investments, and so we want to avoid these. And instead of relying on screens or other filtering and distilling mechanisms, we go in search of the companies we know could be good candidates for portfolios. But it's an open and unrestricted search, and it's based on a quest to find these good quality, great sustainability companies. And we're very choosy about the companies we go looking for, and even fussier about the ones we choose to include in our portfolios. We look for companies whose contribution to a more sustainable future is in the foreground and not in the background, so where it's core to their business model. And these are companies whose commercial proposition is to offer products and services that are necessary and socially useful because they're solving difficult problems or meeting very important needs or helping economies and societies do more with less. And we look for companies with low operational impacts along their value chains. And these are companies with positive cultures and leaders who champion a sustainability ethos, and companies that often blaze trails and move ahead of regulators and set their own high standards, or positively try and influence consumer preferences and tastes for the better. Just a couple of quick remarks on the how rather than the what. The first is that we do sustainability analysis ourselves, so we don't outsource it, although we quite often commission bespoke research by people who know more about specific sustainability topics than we. And the second thing is that we think a lot of what really matters can't be measured and quantified easily or reduced to metrics. So we think it's important to actually embrace subjectivity rather than running away from it. We believe it's our job to weigh the sustainability merits and demerits of every company in the balance, and then make qualitative and subjective judgments about whether those companies deserve to be in our clients' portfolios.
Rob, excellent, thank you. Adherence to a singular strategy. And Thomas, turning to you, what types of metrics are investors looking for today? And can you offer examples for different sustainability areas? And also, how are you applying AI to sustainable investing?
Big questions, important questions indeed. So, I shared a few insights from the recent Voice of the Asset Owner survey, and a couple more things we learned from that survey are relevant to the question about what investors are looking for, but also to the AI question. First, climate matters most to asset owners these days. And when we're talking about institutional investors in climate, it can either be a core holding, in which case they're looking for a fairly broad market benchmark that provides the particular kind of exposure to climate-related factors that they're looking for, or it could be more in line with a sort of thematic approach to climate solutions investing. But in any case, in addition to being informed by the sorts of results we got from the Asset Owner Survey, we also participate in GFANZ, the Glasgow Financial Alliance on Net Zero, and the Net Zero Financial Service Providers Alliance. And one of the clear messages we've gotten from our participation in those organizations, listening to asset owners and asset managers in particular, is that climate indeed matters most. And when it comes to understanding climate risks and opportunities, they're particularly looking for forward-looking data. And at Morningstar Indexes, we're particularly lucky because we have access to data from Sustainalytics, which is one of the leading providers of ESG and sustainability research. And in the past year or so, they've launched a set of climate metrics called the Low Carbon Transition Rating, which provide us with a lot of very useful information for integrating into the various strategies that investors are looking for. And I will say one thing about being in the index business is that no matter what benchmarks you create for investors, when it comes time to license an index for a strategy, whether it's for a particular asset owner or whether it's an asset manager looking to create a mutual fund or an exchange-traded fund, almost inevitably the index gets customized. And so we do need access to a very rich set of data in order to be able to meet their particular needs. Just turning my attention to the artificial intelligence part of the question, one of the sort of interesting parts of the sort of annual nature of the asset owner survey we do is we're in a position to ask new questions as issues emerge. And this is the first year we asked whether or not asset owners are hoping for increased adoption of artificial intelligence across the different components of ESG investing. And essentially, the answers are extremely bullish on their part when it comes to AI. And the top three areas where they cited its benefits or their expectations about its benefits had to do with data collection, ESG reporting, and index creation. And I think that one of the reasons this is the case is because we do live in a very data-rich world, and it's when you're trying to capture information about a wide range of issues for a wide range of companies in the way that we are, given how much data there is, machines can be extremely helpful in helping collect and compile that information. And one of the real benefits that we are already getting and expect to continue to get from artificial intelligence is more timely and more complete data. Now, that's going to be reinforced by the kinds of regulations that are providing a greater degree of uniformity to reporting on the part of companies about ESG and sustainability issues. And so, in essence, there's sort of a virtuous circle being created here. Now, I've worked for in the past, worked for a firm focused on basically gaining insights into ESG issues using artificial intelligence on unstructured data. And, we're really very much at the beginning of this process. And while I think there is a reason to be optimistic, AI is only going to be as helpful as we can make it, in the sense that its real value is in helping humans make more intelligent investment decisions. And so the AI in and of itself isn't going to, if you will, solve a lot of problems, but it is going to enable better decision making on the part of investors.
Thank you, Thomas. And you've each sort of pulled the curtain back a little bit on your approaches, but let's discuss your approaches to sustainable investing in a little bit more detail. And Thomas, staying with you, tell us about Morningstar's suite of low carbon transition indexes and what portfolio objectives they help investors meet. Also, are there other areas for which you've developed specialized indexes also?
Mm-hmm. Sure. So I referenced Sustainalytics Low Carbon Transition Rating, and that data, along with some other data they provide, has enabled us to create a family of indexes called the Low Carbon Transition Leaders indexes. And essentially what we're doing is combining the ability to look at the carbon intensity and carbon footprints of companies, along with evaluating whether or not we believe they're on a credible path toward net zero. And this is, again, this is top of mind for investors. And in the past, we've essentially had to rely exclusively on essentially historical and, in that sense, backward-looking data, namely the carbon emissions data. Carbon emissions data, while imperfect, particularly when it comes to Scope 3 emissions, is improving all the time. Again, that shows up in some of the survey results in the Voice of the Asset Owner. But more importantly, our ability to take some of the forward-looking metrics that have to do with things like whether or not companies are using a carbon price in their internal modeling, what their capital expenditures look like with regard to net zero opportunities and green investments, whether or not there's board responsibility for achieving some of the net zero targets that companies are making. All of these kinds of metrics provide insights into how effectively companies are, in fact, changing their strategies and business models to adapt to a changing economy, and whether or not, in fact, they're following through on the commitments so many companies are making. Now, obviously, it's going to differ from sector to sector and region to region, and we do have sort of the ability to take into account those kinds of nuances. But fundamentally, what we're hearing from investors is they want a new generation of of climate-related indexes that really help them understand at an asset level within a benchmark how companies are doing when it comes to addressing economic, the decarbonization of the economy and their particular role in that. And one of the reasons they want an asset level view of this and sort of transparency about particular companies in a benchmark is because engagement is top of mind for them as they think about how to actually change the carbon profile of the real economy, as opposed to simply reducing the carbon exposure in their portfolio.
Thank you, Thomas. Good overview there. Rob, turning to you, with your bottom-up active management approach, how do you uncover companies that meet Stewart's sustainability standards? And what are some examples of particular regions or sectors where you see opportunities today?
Thanks, Howard. I was just thinking my answer to this is going to sound so low-tech compared with Thomas's answer. But the first thing to say is that we draw on the knowledge and experience of our team accumulated over 30 years. So our team members come from quite diverse backgrounds. And over time, many of us have gained different experience in various sustainability-related jobs and also initiatives, some of which have been practical, some policy-related, and others research-related. The second thing to say is that we meet a lot of companies and we do investment trips. We also follow good people from companies, and we take note when they move to new companies or turn up on the boards of different companies. And this has been a source of some of our very best and most productive investment ideas. And then, like all analysts, we read widely, including the research work of industry experts and trusted third parties, as well as books and blogs. And we tune into podcasts and many other sources of inspiration. The third thing I want to say is that we look for companies that, as I said earlier, are helping reduce ecological pressures and operating within environmental limits, but also contributing to human development. And for this, we use the frameworks that I mentioned earlier. The slide we have here shows the 10 main human development pillars that we look at and map our portfolio companies to. And we cluster these into 4 overarching contributions, which are health and well-being, economic welfare, physical infrastructure, and opportunity and empowerment. And I think these pillars that you can see here give you a decent idea of the sorts of companies we tend to gravitate towards. And if we could pop to the next slide, this slide is showing, it lists the main categories of Project Drawdown environmental solutions that we map our companies onto. And again, I think they're suggestive of the sorts of companies that we're drawn to. If I were to round up my response and try to summarize our idea generation in the pithiest way I can, I'd say that we look for companies that are making the world healthier, cleaner, and more productive. The second part of your question, exciting investment opportunities today and where we're finding them. We keep finding exciting investment opportunities in both developed and emerging markets, but across a wide variety of industries, including, I think, healthcare, information technology, and software, and particularly in faster growing emerging markets, but lesser in developed markets, sectors like financial services and consumer staples companies as well. And the intersection of industry and technologies is also very exciting and interesting. And we're seeing companies embrace industrial circularity and digital connectivity and processing efficiency and automation in really interesting ways, which are allowing them to, pivot their business and operating models, but also developing really cutting-edge products, which are, helping do those things that I said, which is, making the world healthier, cleaner, and more productive.
Thank you. A lot of good insight there. So turning to biodiversity, biodiversity has emerged as a key focus within sustainability, and we're hearing about it as intersecting with related ESG themes, including climate change. Thomas, how do investors think about biodiversity separately or holistically? And how does that translate into index construction?
Thanks for the question, Howard. Biodiversity has been, I would say, emerging in importance over the last 18 to 24 months in our conversations with clients. And biodiversity essentially relates to sort of all living things. And if you combine that with air, land, and water, you get what we might refer to as natural capital. And I'm an economist by training, and basically a macroeconomic production function is going to be based on physical capital, human capital, and natural capital. And one of the interesting things about physical and human capital is that they're explicitly priced. And one of the problems, I think, associated with natural capital is that it is not, in most cases, explicitly priced. And this is, I think, contributed to some of the externalities associated with, land degradation, air pollution, climate change, problems with drinking water and so on. And so, biodiversity has sort of emerged as a related and sort of intersectional issue to climate change. And quite frankly, in our conversations, there isn't a consensus about whether or not it should be treated on its own or treated in conjunction with climate change. We're actually hearing both things from different people. And I think, the implications for that are that there are likely to be sort of indexes and even active funds that are just focused on biodiversity, as well as approaches that take into account that's sort of the overlap between the two of them. And so I think that the fact that we're sort of early stage in the conversation about biodiversity, and the fact that the data is hard to come by, good data in this area is hard to come by, and is just, I would say, again, relatively early stage, means that there's going to be a lot of development in this area in the coming years. And, I would just go back to the early 20-teens, when 2013, 2014, when I was part of a team that was creating the first low carbon indexes, and at the time the term wasn't well understood. It wasn't clear exactly how to do it, and yet we had investors coming to us, asset owners coming to us, and saying, look, we know this is important. We don't know exactly how to do it. We know the data isn't perfect, but what we want to do is create funds that other investors can participate in order to help hasten the development of investment strategies in this area. And so I see biodiversity in a very nascent stage at this point, but I expect that it will become in the same way as sort of the low carbon approaches were a decade or more ago. But I expect biodiversity to become increasingly important as time goes on, and probably treated in its context with climate change, because they are, at the end of the day, I think, very difficult to separate.
Indeed. Thomas, thank you. Rob, how does Stewart incorporate biodiversity into its approach, and how should investors think about it as an investable theme?
Howard, if I can, I'll start with the second part of your question first. We think biodiversity is a broadly applicable and critical consideration, critical for companies, for investors, for asset allocators, but for everyone in society. And we don't think of it as a neat and discrete investment theme, and nor do we think of ourselves as thematic investors for that matter. But biodiversity is about the everywhere and the everything. My favorite definition of it is the living web that connects the organic and inorganic elements of all ecosystems. I love that idea of the living web, because it tells us it's intricate, it's complex, and it's all about interdependencies and interconnections. So we don't think it's easily reducible to an investment theme, and it certainly isn't easily reducible to metrics, as Thomas said. So how do we incorporate biodiversity considerations into our investment approach? 4 things I want to highlight. The first is that we avoid companies that we believe have a significant negative impact on the environment. So that would include mining, fossil fuel companies, big agriculture, and companies involved in deforestation. The second thing is that we invest positively in companies that we believe are working to reduce their environmental footprint, and so reduce pressure on biodiversity. The third thing is that we invest in companies that we believe are actively providing solutions to some of the interrelated challenges listed above. And I'll give you a good example in a moment. And the last thing is that we engage with companies to try and encourage them to improve their operations and disclose more information. And we've done this after commissioning research on a wide variety of topics that are related to biodiversity. So they include sustainable packaging, palm oil, soy, smallholder farmers, industrial circularity, water stress in Indian companies. And we've also done a big strategic multi-company engagement on plastic waste in India. So those are the main ways that we incorporate biodiversity considerations. But I said I'd give you an example of a company that we think is a shining light when it comes to biodiversity. It's Novonesis, which is around about a $31 billion market cap, but Danish listed global bioscience company that produces enzymes and microbes and cultures. And these enzymes and cultures help us reduce food waste. They help us reduce textile degradation in the laundering of clothes. They help increase the yields of crops and also biofuels. They reduce the need for chemical inputs in agriculture. They improve the health and nutrient content of soil. They reduce the use of antibiotics in animal and poultry farming. And they also help clean polluted water. And all these things support biodiversity in different ways. So just one example of a portfolio holding that I think is living proof of the importance of biodiversity in our considerations.
Thank you, Rob. And I like that living web example. let's turn to the regulatory environment. We've touched on it a little bit. Thomas indicated it a little bit in his research earlier, but particularly in Europe, it seems to be trying to influence portfolio allocations for institutional assets. And Rob, staying with you, what are you watching on the regulation front, and what is your perspective, both for Europe and the US?
Our perspective is that financial regulators all over the world are spending more time trying to define what sustainability means and then how it should be regulated. And they're doing this, of course, with noble intentions. The main one being, I guess, to help investors and everyone understand more about what they're investing in and to have their eyes wide open. So, it's not surprising that each regulator is coming up with a slightly different, or in some cases, quite significantly different approach. And we just think there are many ways up the same mountain when it comes to investment styles. And the same is true for sustainable investment. There are lots of different ways to do this, as you set out in your introduction. So for regulation on disclosure, and particularly on sustainability disclosure, to serve everyone well, it needs to be good regulation, and it needs to encourage good disclosure. I think we need to provide better and more meaningful information, not just more data. If it's just about providing more data, the people that will benefit from the requirement for more and more ESG metrics, with the greatest of respect to my fellow panelist, Thomas, will be the ESG data providers. So I think we all need to do more, and we all need to do better to help clients understand better what they're investing in. That's the goal, and it means that we need to understand better where clients are starting from and what they need, and how best we can provide information that's meaningful for them. But of course, all clients are different, and their requirements won't all be the same. So we need to try and come up with disclosure frameworks that I think balance the need for standardization with enough flexibility to allow investment managers to present and communicate information effectively and in ways that they think are relevant for their clients. And I think that all sounds like a job that shouldn't just be left to regulators. We all need to play our part: regulators, investment managers, asset owners, and also the providers of data services.
Thank you, Rob. And Thomas, when you consider the regulatory landscape that we're in now, what should investors be watching in terms of, say, unintended consequences for sustainable investing?
The most advanced regulations right now are in Europe, in the EU, and in the UK. And there are indeed some interoperability questions that have come up in this context. And again, I would ratify what Rob said, which is that I think the intentions are noble. I do think a lot of the regulation a lot of the regulations that have been developed are sort of appropriately within the remit of the regulators. But I think in virtually every case there are essentially unintended consequences that show up, for example, in some of the confusion about the naming of funds in Europe, right, and how they're categorized, and that's just in one example. But I think that it's not just that some funds have been renamed. I think it's actually sort of put a little bit of a damper on fund launches because of the uncertainty around some of these regulations. And so unintended consequences are inevitably a part of regulation. And I would just say that what they should be, regulators should be as light touch as possible, and I would argue as principle-based as possible as opposed to prescriptive.
Excellent. And we have just a minute or two left. Where is sustainable investing headed? First Thomas and then Rob.
Where's it headed? I think more, having just said what I said, more regulation. Likely, I expect more jurisdictions to come online with regulation, say in the next 5 years. I think this will more deeply embed sustainable investment in mainstream finance, which will also deepen the fiduciary obligations to take these things into account. I think one of the undiscussed topics here is that corporates have largely moved from sort of treating ESG and sustainability as PR. Not all of them, certainly, but many of them have, and are thinking about it more from the perspective of driving their strategy and their priorities. And I think that one of the things that's going to surprise people is how rapidly adoption is going to be taken up in APAC. Essentially, with the slowdown in the US and the ongoing sort of momentum in Europe and the UK, I think the different countries in the Asia-Pacific region have an opportunity to leapfrog, to not have to repeat the past, so to speak, but take advantage of the learning that's taken place over the past couple of decades.
Excellent, Thomas. Thank you. And Rob, some parting thoughts about where sustainable investing is headed.
Yeah, I like Thomas's point about the fast adoption of sustainability practices in APAC. I think we're seeing that, and we're seeing some real leading edge companies there. More broadly, I think we're in a time where opinions about the future of sustainable investment are polarized, obviously. There are some people who think that ESG has had its day in the sun and we should wind back the clock to a time when everything was simpler and the social and environmental costs of economic progress could just be overlooked and forgotten about. And then others, and we would include ourselves in this bracket, believe, this is just wishful thinking. We absolutely have to advance human development without exhausting the planet's resources, and this need will only become greater. So as companies and societies experiment with different ways of doing things, I think there's a process of real change that is gradually taking root in countries and cities and communities across the world. And of course, it's a tenuous, messy, haphazard process. And as as was said earlier, I can't remember who said it, it's driven by a mix of regulation and voluntary effort, and it's resulting in patchy and irregular progress. But I think as this process of change unfolds, sustainability considerations will just gradually seep deeper into investment thinking. And if this happens, I think sustainable investment will gradually converge with mainstream investment until we probably stop thinking and speaking of sustainable investment as a distinct investment category. It'll just become a bit like electricity a century ago or wireless connectivity this century, something that's just there and that we take as a given.
Thank you, Rob.